Hi traders, Fawad Razakzada here, market analyst for City Index. So the markets are coming back after falling at the open when economic data raised concerns about a recession. We had weaker than expected GDP and a few other economic indicators, but all that helped to raise the prospects of a sooner than expected rate cut from the Fed, especially as the Fed's favorite inflation measure, the core PCE price index, came in a little bit weaker than expected. We did have some stronger data in the form of personal spending and income, and that eased concerns a little bit. We have big technology company earnings coming up after the close. Meanwhile, Trump is also speaking tonight, so watch out for fresh comments about trade, which could certainly move the markets sharply in one or the other direction. Now, ahead of all of that, the S&P 500 has bounced sharply off its earlier lows. Earlier, it was down about 2%, but now it has trimmed those losses to about 0.8% or so, and it has held the upper side of this broken trend line that had been in place since markets topped in February. So let's see where we close here, and a lot will depend on the outcome of those earnings results from the big technology companies. But from a purely technical point of view, this is precisely what the bulls would have liked to see, a retest of the trend line and a bounce. We also have the 21-day exponential moving average converging there, so that is also offering some support. And from here, where do we go? So right now, this is the key area of resistance. I've shaded in orange on the chart. We have several key levels converging there. For example, this level right here at 5,556, marking the base of the recent breakdown. We have the 61.8% Fibonacci level coming in from the February drop. And we have the low marked from the election day, which is a key psychologically important level for the market now. So if we go above that level in the coming days, I think that would be a strong bullish signal. But until that happens, it's important to remain neutral and trade the market from level to level, especially ahead of those technology earnings and economic data. Interestingly, the euro dollar is finding itself weaker today, despite the fact that we had stronger than expected GDP data from the Eurozone, while today's data releases from the US were mostly weaker than expected. So where do we go from here? Well, I think 113 is a key level of support. That level has been tested in recent days, and so far it has held. I think if we go below that, then the next line of support could be the September 2024 high at 112.15. Then below that, we have this bullish trend line and this key area of support starting at around 111 area. So there's lots of key levels of support that could potentially provide support for the euro dollar on the way down. But with the ECB turning dovish in recent weeks, could we see a bigger drop in the euro dollar? Well, a lot will depend on the outcome of trade talks between the US and Eurozone and China, obviously. In addition, incoming data from the US will be very important to watch, in particular the jobs report on Friday. If we have a slightly bigger than expected number on Friday, that would come as a real surprise to the markets, and that could potentially pave the way for a drop in the euro dollar to below 113 handle. Anyway, the key levels to watch on the upside, 114.25, this level right here has held as resistance after we broke back below it. And that would be the first key level to watch on the upside. Should we go back above that level, then it could potentially pave the way for a run to 115 once more. For more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.